There are some important points to note about last week's market developments. First off, it's a surprise that the dollar ended the week as the strongest currency, making gains against all other major currencies. The news that the Republican Party agreed to lift the debt limit for 3 months gave the greenback a late boost before the week ended. Secondly, risk appetite continued to drive stock markets last week and sent the S&P 500 and FTSE 100 to 5-year highs. But the risk sentiments were not seen in commodity currencies. Instead, steep sell-off was seen in the Canadian dollar against the US dollar before weekend on the above news. Thirdly, the euro remained strong against other European majors and in particular against the Swiss franc. Key medium-term resistance levels in euro-Swiss franc were taken out as funds continued to flow back to the eurozone. However, against the dollar, the euro struggled to extend recent gains. Fourthly, while the yen's downtrend continued last week, it has lost some momentum ahead of this week's Bank of Japan meeting. Fifthly, the sterling was the second weakest currency, just slightly better off than the Swiss franc and closed lower against the yen. Looking ahead, Japanese yen's weakness is still expected, but there could be some notable rebound if the Bank of Japan disappoints markets this week. By disappointing, we mean the bank not delivering what had been priced in, that is a modest expansion of stimulus and doubling of the inflation target to 2%. European majors are mixed as the sterling was rather weak while the euro has been resilient. A short-term top looks formed in euro-Swissy already and we'd probably see some sideways trading this week. Euro-sterling though, has accelerated its recent rally. However, note that sterling dollar will face near-term support at 1.5 at 27 this week and we might see a rebound. Meanwhile, news on the debt ceiling would likely give the dollar an extended boost in the early part of the week. While the Canadian dollar was relatively weaker, the Aussie could catch up any time should the dollar continue to pick up strength. Overall, we think it's a bit risky to add to yen shorts in the early part of the week. Even though the euro could be softer against the dollar, we'd tend not to short them. Our preference would be on long US dollar Canadian dollar and to a lesser extent short Aussie dollar US dollar this week. And another choice would be going long euro sterling. In the US, it's reported that after a closed-door negotiation, House Republicans agreed to raise the so-called debt ceiling for 3 months. The deal was under a condition that both House and Senate will pass a budget within the time to clear the way for long-term deficit reduction negotiations. Nonetheless, that's a move that would significantly reduce the threat of a U.S. government default in the coming weeks. The Fed's Beige Book covering the period from November 14 to January 4 indicated that economic activity in all 12 districts showed either modest or modest expansion. The tone of this report was more positive than previous ones. More importantly, it suggested that recovery in the housing market is underway and this would in turn lift the prospect of other sectors in the economy. News out of Europe was mixed. A successful Spanish bond auction adds further confidence to stability in the Eurozone. And such confidence is a main driver in the reverse safe haven flow from the Swiss franc back to the euro, which was clearly reflected in recent strength in Euro-Swissy, as well as Euro-sterling. However, the euro hit some resistance towards the end of the week as the IMF said that Greece, the center of the Eurozone debt crisis, would face a financing gap of 5.5 to 9.5 billion euros for 2015 and 2016. Also, there were concerns over the Eurozone's economy itself, in particular after Germany reported overall annual growth was pushed further down to a mere 0.7%, compared to 3% in 2011 and 4.2% in 2010. The European Central Bank said in its monthly bulletin that, more recently several conjunctural indicators have broadly stabilized, albeit at low levels, and financial market confidence has improved significantly. And, later in 2013 a gradual recovery should start. It also noted that the accommodative monetary policy stance, together with significantly improved financial market confidence and reduced fragmentation, should work its way through to the economy. and global demand should strengthen. Also, the ECB urged, further structural reforms should be rapidly implemented to make the euro area a more flexible, dynamic and competitive economy. Taking about Euro Swissy, it should be noted that the current weakness in the Swiss franc might prompt the Swiss National Bank to reverse some of its euro purchases for protecting the 1.2 floor to lock in profits. Or at least, they might make use of the opportunity to diversify its reserves. We don't expect that to reverse the Euro Swissy near-term uptrend. But if that happens, the upside momentum might be dampened a bit and there could even be some brief retreat. In the UK, Bank of England Governor King said to a Parliament committee that, it is at a point where the economy is operating well below full capacity, the banking system is in a stretched position and we are clearly struggling to find instruments to ensure an economic recovery. King also noted that, the main problem of the euro crisis is the ability to find a way of financing current account and trade deficits. And, the so-called banking union could just enable countries which have banking systems that need to be recapitalized to have that recapitalization financed by other members of the euro area. Meanwhile, King also said while the ECB calmed markets, it can't resolve the underlying real challenges of either moving to a transfer union or finding a way to take sufficiently effective measures to change the competitiveness of the member countries of the euro area, and a banking union isn't the answer neither. A prepared speech by Prime Minister Cameron raised the danger that the EU will fail and the UK would drift towards the exit. Cameron intended to set out a positive vision for the EU's future where the UK would play a committed and active part. But he also warned that the EU were undergoing fundamental change, and there is a lack of democratic accountability and consent, that is, felt particularly acutely in Britain. The Bank of Japan meeting will be the major focus this week. There were a lot of official comments about the Japanese yen last week. But what matters most is what the bank will actually do. Markets are expecting additional stimulus and a doubling of the inflation target to Abe's 2% level. Also, the government and bank will issue a joint statement after the meeting. It should be noted again that markets should have priced in these expectations already. And, the bank would need to do something strong to impress the markets for giving additional fuel for a rally in yen crosses. That means moves like open-ended asset purchases or removal of the 0.1% deposit rate. Otherwise, we might see a pullback in yen crosses after the news this week. Aussie dollar was weighed down by weaker than expected job data. The job market contracted by 5,500 in December compared to expectations of 4,500 growth. The data series has been rather volatile with a pattern to oscillate from month to month between upbeat and downbeat. But even though November's upbeat data was revised further up from 13,900 to 17,100, the two-month combined total was disappointing due to December's contract. The unemployment rate also rose to 5.4% as expected. Recently released forward-looking Australia and New Zealand job advertisements dropped for a 10th straight month in December, raising the concern that job markets will remain weak down under. And, unemployment could actually surpass the Reserve Bank of Australia's projection of around 5.5% by mid-year and prompt further rate cut from the central bank. Chinese Q4 GDP rose 7.9% quarter-on-quarter versus expectation of 7.8% quarter-on-quarter. Also, that's an improvement over Q3's 7.4% and was the first pickup in 2 years. The data is seen as a sign of strength that would carry on into Q1 and Q2 this year. The World Bank sharply lowered its 2013 global growth forecast to 2.4%, compared to prior projections of 3%. That's just a slight improvement from 2.4% in 2012. The World Bank noted that a global recovery is expected to be closer to the end of the first quarter and into the second quarter of 2013, rather than beginning a little earlier. It warned that the global economic environment remains fragile and prone to further disappointment, even though risks are less skewed to the downside now. And, it noted that policy uncertainty in US has already dampened growth and warned that should policymakers fail to agree such measures, a loss of confidence in the currency and an overall increase in market tensions could reduce US and global growth.